Broadcasting from Baltimore, Maryland, and all around the world, you're listening to the Stansberry Investor Hour. Tune in each Thursday on iTunes for the latest episodes of the Stansberry Investor Hour. Sign up for the free show archive at investorhour.com. Here is your host, Dan Ferris.
Hello, everyone. Welcome back to another episode of the Stansberry Investor Hour. I'm your host, Dan Ferris. I'm the editor of Extreme Value, a value investing service published by Stansberry Research. All right, let's get to it. Let's just talk a little bit about what's been going on lately. USB. Okay, so UBS. I always do that with this company. It's called UBS, not USB. Union Bank of Switzerland is what it used to be called, but now they just call it UBS. So their stock was down like 5% this morning, as they reported that clients pulled about $13 billion out of their wealth management, what they call their global wealth management and asset management businesses. And this doesn't surprise me at all because, of course, what just happened? In the fourth quarter, we had this big, almost 20% drop in the stock market. And of course, investors always respond the same way. They sell, right? That's how those events get going. That's how the market's down 20% in 3 months. There's people selling and pulling money out of things like that. But this kind of highlights something about the asset management business in general. And it's one reason I'm careful about it is that when things go bad, when things go well, it's a wonderful business because you can scale up. Right? It's, just in round terms, I'll just use any old numbers. But if you have 100 million under management, you don't really have to hire a whole lot more people to have 500 million or $1 billion under management, let's just say. Okay. So, your earnings can go way, way up with same amount of expense, right? So lots of scale there. Yet when things go poorly, people, the money just heads for the exits, right? If you haven't locked people up or anything, and they're just in regular mutual funds or regular stocks or whatever it is you've got them in, the money runs out the door. It's one of those things where I think the active asset managers, the publicly traded asset managers, I don't know if they're something I'd want to own near the end of a super long, super expensive bull market. Just saying, just throwing that out there, okay? And, I don't have I don't predict economic stuff, right? I don't predict macro stuff like recessions. But a guy named Ray Dalio, who runs Bridgewater Associates, well, he doesn't run it anymore. He founded it many years ago and grew it up to be the biggest hedge fund in the world. I don't even know how much they have. It's like well over 100 billion under management. It's just some huge number. I don't even keep track of it anymore. But biggest hedge fund basically in the world has had a great track record. Did great he does great near the top of the cycle. Just put it that way. And he's now saying that there is a significant risk of a possible economic recession in the U.S. by 2020, he says, right? And he says, it's going to be globally, global slow up was the term he used. So not just in the United States. So, we see the global wealth division of UBS with the money running out the door. And we see like one of the smarter guys around saying it's going to be a global slowdown. And, you put those two things together, they kind of make a little bit of sense. And again, I'm not like Mr. Bear Market predictor or anything like that. I just think that cycles matter. I'm a value investor, so valuation matters. And we hit the all-time most expensive moment ever in the history of the U.S. stock market back in September, right before it dropped 20% over the next few months. And, we're within, after today's action, maybe 10 or 11% from making a new all-time high in the stock market. And there are people, there's famous people like Byron Wien from Blackstone. He puts out his 10 surprises every January. He's been doing it for like 30 years or something. And one of his surprises is that the market will be up 15% this year. So, people, there are lots of bearish people around. There are lots of bullish people around. And I'm not saying that, I'm not making a prediction. I'm just saying that at this point in the cycle, at this point, at this level of valuation, and you'll hear our guest today later on in the program talk about that. It's just you're just not finding a lot of value. So, UBS doesn't surprise me. Ray Dalio doesn't surprise me that people these things are happening. Another kind of weird thing that's happening overall. This doesn't relate to the overvaluation of the market, but apparently the government shutdown has really impacted the IPO market. So because of the government shutdown, the SEC hasn't been able to approve IPOs. What a weird moment for that to happen. I mean, this is like the president who's bragged about the stock market doing so great since he was in office. And I just, I hope he owns it on the way down too. But you get what I'm saying. We're late in the day. We're late in the cycle, and there's a rational viewpoint to me that one ought to have. And these things that I just told you about, I mean, they don't really surprise me at all. So I just want to leave it there. I think, I just like to tell you where I think we stand. And I'm going to be doing a lot of that because, we are at this kind of precarious place in the world. But right now, actually, I want to get to our guest. All right. Our guest today is Christopher Irons. Christopher Irons started writing about finance and pulling the curtain back on the BS of the industry under his moniker Quoth the Raven in 2013. Since then, he has been quoted in the Wall Street Journal, Financial Times, and Barron's, and has made Seeking Alpha's list of top bloggers, Forbes 100 Twitter accounts in the financial world to follow, and has shared the stage as a speaker with acclaimed investors David Einhorn, Andrew Left, Ben Axler, John Najarian, and many others. Chris Irons, welcome to the show, my man.
It's awesome to be here. Thank you guys so much for having me. I appreciate it.
You bet. First of all, Chris, I wonder if you could just tell us like a little bit about why you started this website, Quoth the Raven Research.
Yeah, sure. The website actually, I only just started, I think maybe 2 years ago. So I started to write under the Quoth the Raven moniker back in 2012, I believe. I was working for a small startup company up in Niagara Falls, New York. And I had always been interested in finance. It was really my first position in the finance world. I was implementing an internal investor relations function for the company. So it was a great way to learn a ton about securities law. But really, I wanted to just basically earn a little bit of extra money on the side, which is why I started writing. I started writing because Seeking Alpha had this great platform where you could express your opinions on companies, and they would kick you a couple bucks for an article if it was something that their editors approved of. And certainly I had my fair share of terrible garbage that I wrote when I was back in 2012 and 2013, still kind of getting my feet wet on things. And yes, I kind of just started doing it as a hobby, really, to be honest with you, for beer money, basically. And then as I was working at this job and perusing Seeking Alpha in the midst of when I started writing for them, and if you go back and read some of my early stuff, I mean, it's truly terrible. It's awful. But while I was on the site, I came across GeoInvesting's article about Long White Petroleum, which was one of the many brazen U.S.-listed China-based frauds that they've exposed over the years. And that's how I actually wound up finding out about GeoInvesting, which is located back here in Philadelphia. So when I left Niagara Falls to come back home to Philly after things didn't pan out at this company, I then kind of found my way to this new job at GeoInvesting, where I've been for almost 5 years now, and then started to, as a condition of my employment there, I told them I wanted to continue to write as Quote the Raven also, and they didn't have any problem with that. I've always written under my own name as well, and I don't know, it's done very well, and really I've spent the last 5 years learning, to be honest with you. So my Twitter followers and people that email me and read my stuff have probably watched the level of my analysis evolve slightly over the last 5 years, because it was pretty much bilge I was putting out in 2012, and but I have a quick learning curve, so I'm a quick study, and feel like I still have a lot to learn, but I feel like the quality has gotten better, and some people have taken notice, so it's worked out very well.
Yeah, I mean, I think the quality is great. I follow your stuff. I love it. So, yeah, you started this thing as a hobby for beer money, and it took on a life of its own. That sounds like a familiar story. The first time I saw you, Chris, I saw you speak in public. That was really my first exposure, and it wasn't too long ago. It was at Whitney Tilson's short selling conference. And yeah, I thought you were like by far the most entertaining speaker, but you shared some thoughts that, I wonder if you would mind, just kind of summing up. And your position was to buy gold for a specific reason. And, we're trying to get the listeners to be better investors and think more about things. And, I think you can probably help them think about why one might want to own some gold right now.
So I'm not an investment professional, and I don't really tell anybody to buy this or buy that. And I certainly, wasn't there pitching to other people that, hey, I think you guys should all buy gold. One of the things that I like to do, and I was thinking just a couple weeks ago, like, what's really my mission statement as a Twitter personality, as, somebody that writes research? What's kind of the underlying theme that is an umbrella over some of the company-specific analysis that I do and these speeches that I give? And really it's two things. One is maybe just have a little bit extra skepticism about the system, the way that it exists today, because I do think a lot of the system is bullshit. And the second thing is really to act somewhat as a counterbalance to a long bias that I think is inherent in the media and just in the world of finance. And I'm not saying that that's absolutely 100% the best thing to do and that you should go become a short seller and short the whole system and put all your money into gold, because I wouldn't make such a specific recommendation, number one. And number two, that's really not what I'm saying. The point of I had the idea for my speech, which was called Short the Whole Thing. That was the name of the speech, because he wanted us to come and talk about something that we would short. And my answer to that is I would like to short everything, because I'm not fond of the way that everything is set up in the way that we run monetary policy in this country, and really what our position is on fiscal policy in the country. It doesn't really make sense to me. Maybe it's because I was just raised in a house where I was taught to save and not to take on debt, which seems like two very simple concepts. And when you finally wrap your head around a little bit of macro and you start to understand that spending and taking on debt is really the centerpiece of how we think about monetary policy and how we think about economic theory, to me, that gives me a little bit of pause. And everybody in the industry is indoctrinated to think that this is the best and most efficient way to do things. And it certainly is for politicians and for people that can benefit from unlimited, money printing when the government wants to spend more than it can afford, or when politicians want to get reelected. But I view the system as a lot of very standard basic economic rules that anybody can understand, like supply and demand and sound currency, that has mutated and been morphed into this, human-centric system that is set up primarily to benefit politicians, to benefit the government, to benefit, the big banks and the big institutions. And I don't really like the way that the Fed does business. To me, it seems like there's probably a happy medium. Even like Ron Paul says, I don't really want to end the Fed completely. I just want to name it and get to a point where it's doing far, far, far less. I'm not 100% against central banking. I think there's probably a happy medium there. But I think we're so many standard deviations in the wrong direction right now that I would be remiss from a intellectual honesty standpoint if I didn't speak what was on my mind and say what I say and what I believe in. And that is, we need to be more skeptical about the way that everything is set up. If we think 2008 can't happen again, we're wrong. If we think that the next bubble burst of that scale won't be orders of magnitude bigger than 2008, we're wrong. And it's very simple when you think about it through a Keynesian lens, right? I mean, all you're doing is solving bubbles bursting by creating bigger bubbles. And you do that over and over and over again until at some point either your country has a sovereign debt crisis or the currency turns into Swiss cheese. So to me, that is an inevitability. Whether it happens in my lifetime or not, I don't know. But the one way I like to hedge against that whole kit and caboodle is by owning some gold, which has had value as an economic instrument for thousands of years and has been a store of value for thousands of years. To me, it just makes sense that at some point we'll have a little reversion back to the historical mean there. And aligning with that is my skeptical and critical view of the financial media, which to me, I think most people are probably don't even think about the system as a whole because people have been so indoctrinated to accept that the government and the Fed understand what they're doing. When if you've ever walked into a DMV, it couldn't be more obvious that you don't want the government running things, right?
Yeah.
But so I always just say, look, it's nice to have a counterbalance. It's nice to have somebody that critiques these people and kind of keeps them a little bit in check. And I'm not saying I'm 100% right or I'm 50% right or I'm 25% right or that, you know, that I will ever be proven right to that degree. But I do think it's healthy to have some discourse about it. And that's really kind of my position on everything in, 5 minutes or less.
Right. So gold for you then is it's an insurance policy as it is for many people. Is that fair?
Sure. Yeah. I mean, why do you think central banks hold it in reserve, right? They hold it in reserve to hedge against inflation, to hedge against systemic risk. And I think if there's one thing that the Fed is doing right and that central banks do right, investors can kind of take a cue from them. Nonsensical way to think about it, because nobody gives a shit about a dividend when the, market pulls back 50%, then big deal. You collected a dividend for a couple of years before you got your ass handed to you. Congratulations. It's not for that purpose. The purpose is kind of as an insurance policy. And as long as it's denominated in U.S. dollars, the more dollars we print, the more value that will eventually be assigned to an ounce of gold. And you'll see some of that with other commodities as well that are finite in supply. And I'm just, to me, it's just a safety net and like to be safe with my capital, some of it.
Makes sense to me. So when you are not shorting the entire, shorting the whole freaking thing, as you put it, I notice a lot of the stuff on your website is, you're very skeptic and you like to talk about your short ideas, it seems, more than anything else. And just so the listener knows, for example, a recent podcast of Chris's was called Our BS Economy, Part 6 of 515. So he will be going on and on and on with this idea of shorting the whole thing. It's great. So, but it seems like, I can't remember. I mean, I'm not super familiar with all of your work, but most of it is like this hardline skeptical. I can't find any longs, I guess is what I'm saying. You don't seem to write about longs.
I have written about longs. Yeah.
Okay.
And I do, I do invest long in companies. I mean, it's a very simple equation. I'm not Mr. Super Skeptical about every individual company. I just wait until you see deep value to get in on the long side or an obvious mispricing. It just so happens that our market as it exists today is chock full of nonsense companies that are not turning a profit, that don't generate cash, that have asinine valuations. And so, when the average investor with a long bias goes out and throws a dart, they're likely to hit one of these companies and go, oh, it's a growth story. Great. I better get in long. But for me, it's not like that. I view each company individually on its merits. And, chances are 99 times out of 100, the market has assigned either too high or too low of a price to your particular equity or whatever part of the capital structure you're talking about. And my goal as an investor isn't to say, oh, I'm always long or oh, I'm always short. The goal is to find out how badly an equity or whatever other instrument you're looking at is mispriced, and then make your decision accordingly. So it's not like I'm walking into, if you just hand me a company today and you're like, hey, what do you think of, whatever, American Express, knowing little about how the equity is valued, I'm not going to go in and be like, hey, short it or hey, go long without knowing anything about it. I mean, everything is kind of generally overpriced here, so maybe it's more likely than not that I would look at it with a skeptical angle. But, in the midst of the 2008 financial crisis, when the markets got absolutely destroyed, I'm sure perhaps I would have been more likely than not to look at things with maybe a long perspective a little bit more than a short perspective at the time. I mean, it all depends. I just think I generally don't buy what I'm given without researching it and validating it for myself. So, but for instance, I thought that I went long some of the banks recently. For geo investing, actually made a call to buy Goldman Sachs at 155 on this recent dip when my good friend and Twitter handle Kubico pointed out to me that their price per book was under what it was under during the worst point in the financial crisis. I thought, okay, that's probably a little overblown for where we're at now, even thinking that, we are probably heading into a recession. I don't think we're at the end of an enormous credit cycle like we were in 2008. I think we're probably at the end of a shorter term credit cycle, less kind of systemic one. So I see something like that, a mispricing like that, and that makes a lot of sense to me. Are we systemically on better footing than we were in 2008, all things being equal and, kind of putting aside the whole thesis of everything is yes, I think we are. And so a call like that makes sense to me. So, we bought Goldman Sachs at 155 3 weeks ago or 4 weeks ago, and, it's at 195 today. So that's an opportunity where I saw something on the long side that I liked. And there's been other instances of companies I've gone long. So I'm long gold. So, yes, it's a short of the whole system, but that's still a long. I own some gold miners too. So I'm long those companies. And then I'm also long, at geo investing, we look at a lot of microcap stocks. There's still a lot of deep value in some microcap stocks because they're very illiquid and often mispriced, underfollowed, undercovered by analysts. And you can usually get good access to the management team to get color on operations. And, certainly you don't want any material non-public information, but the companies are a little bit more accessible to talk to. So we find some deep value situations in microcaps too. So a lot of times I'll go long smaller cap or microcap names, but then you look at a company like Tesla and it's like, how are you expected not to be a skeptic? How are you expected to not understand that no matter what the macro environment is, you can't run a company the way that they've been running it and expect this valuation based on a story of everything's going to be unicorns and rainbows someday to hold up. To me, that just doesn't make sense.
Yeah, it doesn't make sense to me how I know it recently dropped, and I think it might have dropped even today below 300. But the persistence of a valuation in excess of 50 billion next to companies like BMW and GM and things with similar market caps that know how to make money making cars. I mean, that's got to be a prerequisite to a big market cap. I'm just crazy suggestion, I know, but I have marveled at the persistence of this story. I mean, he hasn't exactly been like, that is to say, Elon Musk hasn't exactly been like the ideal public face of a public company, right? How is this thing still like, how is it still in excess of 50 billion in market cap? Can you help me with that?
Well, it says a lot about our market as a whole, right? So it says a lot about the way that people are looking at equities in general. People are looking at equities, Jim Cramer said a couple of days ago, I put on Twitter, He's almost scared not to buy stocks, okay? And this is after the S&P has tripled over the last 10 years, all right? That is insanity. To make a statement like that, I think is just insane. I think that's an insane way to look at a market that is significantly probably overpriced at the end of a credit cycle where now, we're not even going to be able to continue raising rates because we've essentially, I think at this point, already triggered a recession. But nobody really cares. And as with any type of major correction, recession, pullback, whatever you want to call it, these things, they take the stairs up and then they take the elevator down. So with Tesla, I don't think it's going to be a slow bleed. I think we're going to wake up one morning and one of the major shareholders may have sold, or something's going to happen with Musk. There are a lot of people that own that stock that need a serious reality check, including institutional investors. But they're pricing that company not as a car company, as you know, which would normally be assigned a price-to-earnings ratio probably 6 to 8, but as a tech company, okay? And if you want to be a tech company, you want to look at the top-line growth, which I guess is what people are doing, and there's this whole case for they're going to have autonomous self-driving taxi vehicles down the road. I mean, These guys, they can't even execute being a car company. They're laying off employees already, and they've just made layoffs, I think, last year also prior to this. People are having trouble getting their vehicles serviced. People are having trouble getting their vehicles delivered. So look, it was a nice idea for him over the last couple of years to create this brand and come up with this buzz. And certainly I think he's been a very poor CEO and a very bad, steward of his shareholders' capital, but that's just my opinion. And at some point, reality is going to hit. And I don't know what it's going to take for that to happen, but at some point people are going to realize this is a car company. This is not a technology company. And they're in a race against interest rates right now. They're in a race against their debt maturities. For some reason, it certainly seems to appear to me that they aren't able to raise capital because I think they would have done it already. They have massive outstanding legal liabilities. The Department of Justice is reportedly investigating them for misleading the public with their Model 3 production timelines. They have been unable to keep a multitude of promises that the CEO has made. The CEO comes off, to me, as an exceptionally unstable individual that doesn't really care much for the rhyme, reason, or regulation of the public markets. He look, to some degree, being a visionary and going against the grain is a very good thing. That's how you affect change and how you come up with these novel innovations. But at some point, you have to settle into a role as the CEO of a public company, and there are certain guidelines and rules you have to play by. And he just doesn't seem to care about any of them. So I think he's a major liability. I worry about his mental health, which I don't think – I don't know. To me, looking from the outside in, it looks like he may not be doing well, which is worrisome. Of course, obviously, you don't want anybody to have any kind of breakdown or something. But, he's got a lot of explaining to do, and he's say what you want and ask questions later type guy, and you can't do that as a public company CEO. You can't. There's a fine line between setting aggressive targets and misleading the public. And I just don't know. It just, to me, it feels like reality will hit at some point with the story.
Yeah, I agree. It's the kind of thing where you wake up and it's been cut in half. And I also agree that he does seem like an individual who I hate to say this about any human being. I wish the guy well. He's got, cojones. He's done a lot of really interesting stuff here, but he does seem like he's way overcommitted to all kinds of gigantic projects. And I find it hard to believe that anyone is that both brilliant and energetic and all the things he'd need to be to not have a serious problem in that regard. But let's move on. Let's talk about another company that you've written about, if you don't mind, if you don't mind talking a little bit about Herbalife. Is that one you don't mind talking about?
Yeah, well, Herbalife is one of the reasons that I started getting into writing about financial companies to begin with. So back in 2012 or 2013, whenever Einhorn first started to stir up some public controversy about the company, shortly preceding Bill Ackman's major short and the big battle royale between him and Icahn was really the first time I had heard the company's name in years, 15 years or 20 years. And I remembered it as a kid, always watching these infomercials at home. There were two types of infomercials when I was growing up as a kid, and I would get home from school and put on cartoons or whatever. There was always the real estate with no money down commercial, infomercial, and then there was always the work from home infomercial with John Tartle and Leslie Sanford. And I remember Herbalife from like the 90s kind of being like this cultish kind of weird, with the buttons and the people all singing and dancing together, and like it was like a little like religious movement. It was just kind of freaky to me. And then I didn't hear about it for a long time, decades, right? And then I wake up one day and find out, okay, it's a public company, and not only that, but now it's at the center of this controversy about whether or not it's a pyramid scheme, which of course I knew even when I was 15 years old. I thought the company was bullshit. You would watch these infomercials and just be like, look, anybody that thinks that they can make money doing this is insane. And as with any infomercial, and to find out that not only was it still a company that existed was baffling to me, but that it had also been securitized and was now trading publicly, I thought was also insane. And I kind of wondered, over the last 15 years or however long it had been, and I lived in downtown Philadelphia for a decade, and I spent some time in Buffalo and in Canada and in New Orleans and kind of all over, and you just don't ever see this stuff. You don't see the distributors. You don't see the products. You don't, it's like you just don't see it. Maybe I'd pass by a nutrition club once or twice. They don't even put the brand name on those things. They have to just cover the walls in green wallpaper. So right off the bat, I was like, well, this is insane. And then the controversy started with Ackman was going to come out and short the stock, and he put on this big presentation. So I watched the presentation because I was really fascinated by it. I think I found it to be like, when I was a senior in college, I wrote this religious rhetoric paper on Scientology like a long time ago before it was this big public controversy that it is now. And one of the reasons that I wrote about it is because I found the psychology of it fascinating. And this Herbalife thing fell right into that same groove with me. I was like, this is weird. It's weird that this company still exists. It's weird kind of how they do business. At one point, I had a professional this was afterwards when I came back to Philly, but I watched Ackman's original presentation, which 200 slides and 3 hours long, and I watched it many times over, probably 50 or 100 or 150 times, and I thought he was spot on. I mean, his argument was, look, you have a company making a commodity product that's available at GNC under a different brand name, Lean Shake, for a certain percentage less. You can buy it anywhere on eBay or online. There's no need to become a distributor, an Herbalife distributor, if you actually wanted the product. And his argument was that the only reason the product sells is because it's stapled to a business opportunity that is giving people the impression that they can be entrepreneurs. And his original thesis made a hell of a lot of sense to me. Still does to this day. And I think if Carl Icahn hadn't stepped in and backed the company and lent his name and his gravitas and his capital to lock up a significant portion of the share structure, that this one may have turned out different, but everybody knows how it turns out. I mean, I wrote a ton of articles on it. I never, people were accusing me of working for Pershing Square and all this shit. Never worked for Pershing Square, did all my work on my own, was like, very into it though. I kind of became like obsessive about it for a couple of years. And because it's just one of those things where it just didn't make sense. And I found throughout the course of my life, if it doesn't make sense, it's probably not true. You don't need to, it helps to do a deep dive on a lot of things, but sometimes you just need to look at things at face value and say, hey, that doesn't make sense. It's probably not true. And there was a lot about this company that didn't make sense to me. So it set me off on a multiple year research kind of obsession into the company. And you can go look at my, Seeking Alpha, all these other things. And I went to Ackman's second presentation, the Nutrition Club presentation, when the stock rallied, of course, that day. And subsequent to that, the stock traded much higher, and the FTC ultimately, the thesis that the FTC was going to shut down the company was one that I actually believed in, because it was so clear to me that the company, in my opinion, was a pyramid scheme. I wondered how they could miss it, but, I learned a difficult lesson about putting your faith in the government and about, political connections and lobbying and all of the things that, whatever it was that prevented Edith Ramirez at the FTC from putting into the complaint that the company was a pyramid scheme, which those words were not used, whatever bargaining chip they had to put into play to do that, is, I think, ultimately, plus a beautiful PR job by Herbalife. I mean, they did a fantastic PR job of trying to spin, their side of the story, all of which I thought was bullshit, of course, but they really should be commended for the PR job they did. And to this day, so obviously the stock has gone way up. So the trade had been a total failure. I lost a lot of money shorting the stock along the way. Admittedly, I haven't had a position on the name in probably a year and a half, because it's a very difficult stock to trade. The shares outstanding has been reduced greatly. All of the things, the reason that bulls own the name, make it that much more difficult to short. A lot of the outstanding shares are locked up. The float is very small. It trades by appointment. But to this day, if you go back and read the Federal Trade Commission's complaint against the company, ultimately they entered into a settlement agreement. But if you read their complaint against the company, it validates everything that Bill Ackman was arguing and everything that skeptics of the company were saying about it. They found that they were misrepresenting income claims to people. They found that a majority of the participants joined for the purposes of recruiting other people and not to, not for retail purchases of the product, which is by definition a pyramid scheme. But for some reason, they did not call it a pyramid scheme. And famously, when Edith Ramirez was asked at the post, announcement press conference whether they found the company to not be a pyramid scheme or not, she said, it was not found that the company was not a pyramid scheme. So she kind of just reverse worded back into maybe saying that it was. But there were some terms of the settlement between the FTC and the company's lawyers, who, again, probably did a fantastic job. This is the best possible outcome that this company could have gotten from the campaign that was launched. They did everything right along the way. But to this day, I have a lot of difficulty. And look, some people will call me delusional, and some people will make fun of this, and that's fine. I'm perfectly okay with it. But to this day, I still have a lot of difficulty figuring out and understanding how the company's business, especially in places like North America and in Mexico, where they had to make significant changes to their business model, has been able to continually produce the recurring base of revenue that it has. I understand in practice how it happens. I understand how the company's business model works, but I'm having trouble reconciling how the business model works with where this money is coming from and why these, quote unquote, products are being purchased. You have people now qualifying for this president's team, which is the top part of the echelon for the company, faster than they ever have before, and with more volume points than they ever have before, which is really their way of measuring how much of this crap you buy. People are doing it faster and with more volume points ever at a time when the FTC has imposed sanctions on the company's business model that should be suffocating it. And to me, it still falls in the box of does not make sense. So maybe you can say I've just held on to this thesis for so long and I'm delusional and I should just give it up and, realize that I've lost. But I still think to this day that there may be some things that we find out in the future that people may not have been made aware of. So I'm very skeptical of it. And I think the entire multi-level marketing business model in general is bullshit. It's total nonsense and bullshit. So it doesn't matter whether you're selling essential oils or you're selling sex toys or you're selling nutritional products. If you're involved in a company where your business model is to recruit other people to sell the same crap, the same usually overpriced commodity shit, whether it's Herbalife or not. That business model doesn't gel with me. It's a breeding ground for pyramid schemes.
Wow. Yeah, I hear you. I've always wondered about Herbalife, though, whether the questionable business model aside, if you can put that aside, like, are they guilty of any like real fraud? In other words, like they're selling. I think they really do what they represent. I mean,
a pyramid scheme is a fraud. It is a massive fraud. It's akin to a Ponzi scheme, right? So what you're saying is, hey, aside from the business model, is there any fraud? And my argument is the business model is fraud. And, the company did a very good job throughout the course of this criticism, kind of washing over a lot of this shit and making it unclear. Even people that worked within the FTC were confusing the terms Ponzi scheme and pyramid scheme. You can't run a pyramid scheme. It is inherently a fraudulent model of business. So and that doesn't mean that there's not other little smaller instances of fraud occurring at the company, which I believe, in my opinion, there is. But just that aside, the overall bird's eye view, 30,000-foot view of the business model is a fraudulent business model, in my opinion. So you just can't have a pyramid scheme running as a pyramid scheme. A pyramid scheme by definition is when more than 50% of participants are joining to recruit other people and not for purchasing of the retail product. So when that scale tips in the balance of 51-49 or 50.1 to 49.9% or whatever, and you can't prove that more than 50% of your participants are signing up to purchase the retail product, you're by definition, according to, past SEC cases, you're by definition running a pyramid scheme. And not only that, but our new presidential candidate, Ms. Kamala Harris, who just declared that she was going to be running for president a couple days ago, had the chance to enforce a permanent injunction in California that was signed in 1986 specifically to prevent this company from getting out of control and turning into the shit show that it has today. In 1986, there was a consent decree entered into between the state of California and the company saying that they wouldn't make false income claims. They wouldn't make false health promises. They went through all this shit decades ago because the guy that started this company, Mark Hughes, was, out there saying whatever he needed to say to sell this stuff and to move this stuff. So Kamala Harris could have enforced a permanent injunction that was already in place since 1986. But not only did she not do that, she married a partner at a law firm that has represented Herbalife in the past. So that's what was going on in California. But this should have never grown and mutated into the company it is now. Went private, went public again, went private again. Every time companies are looking to take it public, they're looking to make a return on their investment after they took it private. They bring in Michael Johnson from Disney. And now you got this mysterious behemoth of a company that's got an enterprise value of like $7 billion or $6 billion or whatever it is, with selling a product that nobody owns and nobody has ever heard of. The only time I saw Herbalife products over the last 10 years in my actual life was I had a very good friend of mine who played soccer for the LA Galaxy. And they were at one point sponsored by Herbalife. I think they still are, actually. And when I was helping him move, because he moved to Philly to play for the Philadelphia Union, when I helped him unpack his shit from L.A. to Philly, he gave me a huge box of Herbalife stuff. This was like, I'm trying to think of what year this was. This was right around this time. Actually, this is before I left. This is maybe 2008, 2007. And he was like, here, man, I don't want this shit. I don't use this stuff, whatever. It was all unopened stuff. So at one point I had actually tried the products. I tried they had like an energy drink called Lift Off, these little pills that you drop in water. And I had tried like the Formula One. And it was all crap. It was all garbage. And that was the only time I ever saw the product, was when this guy who was on a soccer team that was sponsored by the company was looking to throw out a big box of crap that he had because he didn't want it anymore. and that's it. So now you have a $7 billion company that do you see this shit on a daily basis when you leave the house? Do you see Herbalife products when you go out?
I've never seen them anywhere, ever.
Right.
Not once.
And where do you live?
I live in Washington, near Portland, Oregon.
Okay. So you're in Portland, Oregon. I've traveled all over the United States. I've traveled to many places outside the country. You know, for 36 years old, I've been around and I've seen some things. I've been to poor neighborhoods. I've been to rich neighborhoods. I've lived in poorer neighborhoods, lower income neighborhoods. I've lived in middle class neighborhoods. I've lived in all over the place. For all intents and purposes, this stuff doesn't exist. I mean, it just doesn't even seem like it's out there. Yet here it is. It's this $7 billion cash generating entity that's somehow running on this model of recruiting other people is just, you know, a Wall Street darling, and its stock has gone through the roof. To me, something there doesn't make sense. I don't know what it is, but maybe we'll find out at some point in the future.
Yeah, and until then, I mean, the thing is like, you know, if you look, I got a max chart here. It goes back to 2005, and it's within pennies, less than $1 of its all-time high close here. It looks like, or somewhere thereabouts.
At a time where its gap net income, you know, is declining, right? At a time where its debt is skyrocketing and its free cash flow, I believe, is in a downtrend still. Something doesn't make sense somewhere. You know, and then recently, too, you had the CEO just stepped down, Michael O. Johnson, who, to give him credit for anything, which I don't like to, but to give him credit for anything, he stood tall in the CEO role while this whole mess was going down. And then finally the FTC order gets entered into, and then he steps out to let Rich Goodison, who's been at the company for a while, and also it's a whole other conversation about why they continue to promote from within and not bring people from the outside, but that's a different conspiracy theory for a different day that I have. And now all of a sudden this Rich Goodison mysteriously resigns a couple weeks ago for comments, something like the 8K said something like comments that were, you know, unbecoming of the company's business standards. And he just kind of mysteriously resigns after being at the company for a long time, and he gets a $3.5 million windfall and signs a separation agreement where he's got to keep his mouth shut. All these weird little things keep happening. I have a theory about that it has something to do with the company's FCPA investigation that's currently taking place, I think, with regard to their China operations. I think maybe somebody found something somewhere that he may have said that they didn't like, but that's all just speculation. But anyway, so this guy just mysteriously resigns as CEO, and Michael O. Johnson's back in, and Carl Icahn, you know, God bless him, made a killing on his investment, but it was very evident through what he said publicly about this company that he didn't have a clue how the business model worked, or, you know, he got the ticker symbol wrong on live television. Okay? So let's just start there. All right, you're going to tell me this guy did the rigorous due diligence that Bill Ackman did? And look, a lot of people give Bill Ackman shit, and that's fine. There's one thing you can't say. Even though he lost a shitload of money on this investment, I still can't say that his research he did on this company was incorrect, because the way he laid out how the business model works, and if you have the time and you're bored, go onto YouTube and watch his original presentation on how Herbalife's business model works. It's like 2 hours long or 3 hours long. He does it with this guy, Shane Deneen, who was one of his analysts at the time. And they explain in rigorous, painstaking detail how the multi-level marketing business model works. And if you want to have your eyes open as to why this industry operates the way it does and why this model is so insanely complex that the layperson could never in a billion years figure it out without doing an insane amount of research, all of that is for a reason. You know, I think the business model is cloaked in all of this complex kind of details and word changes and jargon for a reason, very similar to the same way I believe that the financial industry uses jargon and financial terminology for things that most people would understand if they just called them by what they were. And I think that's one of the think the financial world is like that so that the layperson doesn't understand how the whole thing works, because I think if they did, they would riot. And I think probably similarly in the multi-level marketing world, they use a lot of jargon in a very complex business model to perhaps cloak to the layperson how the business is really going down, and maybe even to disguise to potential recruits what it is that's going on. That's all just my opinion, though. That is just my opinion. I'm not a financial advisor. You can take it or you can leave it, but I will go on record again and say I think something still doesn't add up with that one for me. But that's that. I mean, I could talk about Herbalife for 9 straight hours if you wanted to.
Okay. Well, I think that's actually a good place to leave us, Chris, and you've been very generous with your time today. And
sure.
I'm glad you went off on Herbalife. Yeah, that was like a great presentation, you know. So
well, I think if people that are listening to the podcast want to take a step into an angle on this company that I did not get into, that I think probably is worth looking into in detail, there is a website called Plainsight, Plainsight. And they produced a document that lays out Herbalife's history with the drug trade going back decades. And that document is freely available. It's a PDF. I think it's about 80 pages long. It was authored by Aaron Greenspan at Plainsight and Christine Richard, who led a lot of the investigation into Herbalife for Pershing Square, for Bill Ackman at the time from Orion Research. And I think there's a link to it on my website, too. If you go to quotetheravenresearch.com and you scroll down to, like, things I read or whatever the hell I call it, I think there's a link to it down there, too. If you want to have your eyes open and you want to have your fucking hair blown back a little bit, go and read that document, okay? Maybe watch Bill Ackman's presentation, then go read that document, and then just ask yourself the question of how is this company, where is the money coming from? That would be the question I would ask. And I'm not making any kind of conclusion here. All I'm saying is that something seems to me. And that would be a great place to start and do some reading if this is something that interests you.
All right. And that's unfortunately a place where we're going to have to stop. But wow, thank you so much. And I hope, who knows, maybe if we wake up one day and this thing's down 50% or so, you can come back and talk about it.
I'll come back on anytime, man.
Okay, great. Thanks so much, Chris. I hope we'll be talking to you soon.
Thank you guys so much. I really appreciate your time. Thank you for having me on.
All right, now it's time for the mailbag. Remember, your feedback is important to the success of our show, and you can email us with a question or a comment or whatever at feedback@investorhour.com. We read them all, and we try to respond to every single one, even the hurtful ones, okay? So let us have it. Just got a couple items here today in the mailbag. Number 1 says, Dan, always look forward to Investor Hour. The topics have encouraged me to move from the Stansberry Investment Advisory to recently becoming a Stansberry Alliance member. Good for you and welcome to the fold, is what I say. But the email goes on and he says, when the market took a downturn in December, I wondered about ETF risks. If an ETF has severe problems, I assume in theory it could go to zero and cease functioning. But are there additional concerns with ETFs that short the market? If we were shorting a stock and we were on the wrong side of the trade, we would have to cover the short. What happens with an ETF that shorts the market? Are we on the hook for more than our initial investment if the trade goes against us? That is a really good question. I don't know the mechanics of how they would work that out because, as you say, you know, a stock can double or triple on you or something, and you can lose more than you'll ever win by shorting. But the bigger problem to me, and the reason why I think you'll see some of these things blow up at some point, is that the shorts, especially, they tend to use leverage. So it'll be like the 2x short fund or the 3x, or I think they actually have the 4x short fund for some index or another. And that's really that's the screwy thing. I mean, these things are obviously made for day traders, right? And overall, I'd much rather short individual names and be very careful about it than buy a short fund. I'm not going to say much more than that because I haven't done a lot of due diligence on short ETFs, but I hate the leverage and I would rather short individual stocks. And that's Eric R. Sorry. Thank you, Eric R., for your question about that. So one more email here. Okay. This is from Gary P. And Gary P says, Dan, I just recently started looking into investing in the market. I am not well educated on any of the processes and would like to try with some small investments. I did consider trying to use a broker, but I am more interested in making my own investments from the comfort of my home. I just started listening to your podcast to get some insight on some potential investments, and I would like to get your thoughts on investing in the most recent events that is happening in my state. I live in Michigan, and we just voted to legalize the use of marijuana. There has to be some potential opportunities of investment as a result of this decision. I'd appreciate your spin on this topic. Thank you, Gary P. And thank you, Gary P. Let me tell you something, Gary. You don't need to be in a hurry here. That's the mistake that people make. They want to get in on a hot thing. They want to get in on the craze at the beginning and make a lot of money real fast. That's a bad idea. Marijuana is farming, and now it's got kind of a retail angle on it, right? So they farm the stuff at marijuana farms, and they make all kinds of different products, frankly. Everything your heart desires, all kinds of edible things and drinks and various ways to smoke it. There must be 10 different ways to smoke this stuff. I'm not kidding. It's crazy. I live in Washington, so I know a little something about this. And all I will tell you is that I don't think that this is a great business. I don't think farming is not a great business. It's a highly cyclical, highly capital intensive thing, highly competitive. You generally don't get much control over the price of what you're selling. This might be different, because it's, people smoke marijuana to get high, it might be more like, alcohol or tobacco or, which tend to be good businesses. But the good part is the front end. All the value add is going to be after the farm, right? So the value add is going to be in, companies that make all kinds of different products, drinks and whatnot, and companies that maybe run good retail operations possibly. But if I were you, the most important thing is don't rush into it. You think you need to rush into it. You can actually wait until all the crappy businesses get washed out. You can get a company that's full of hype and the share price is way too high and it's gone way up and everybody thinks they need to buy it. Don't buy it, because if it's a real business, one day it'll get dirt cheap and you'll be able to buy it and make some money. Case in point, Microsoft. It went absolutely bananas during the .com years, and then it crashed horribly. I forget how much Microsoft was down, probably 70 or 80%, just like most of the big names were. And it finally broke even like a year or two ago, but it took a long time, and you had plenty of chance to get into it at a very good price and make plenty of money. All right? Don't be in a hurry. That's my advice. Thank you for that, Gary P. All right. Well, that concludes another episode of the Stansberry Investor Hour. Be sure to check out our newly revamped website where you can listen to all our episodes and see show transcripts, and where you can enter your email to make sure you get all the latest updates. Just go to the same address, www.investorhour.com. That's it for this week. I'm your host, Dan Ferris. Hey, folks, love us, hate us, just don't ignore us. Thank you for listening, and we'll talk to you next week.
Thank you for listening to the Stansberry Investor Hour. To access today's notes and receive notice of upcoming episodes, go to investorhour.com and enter your email. Have a question for Dan? Send him an email at feedback@investorhour.com. This broadcast is provided for entertainment purposes only and should not be considered personalized investment advice. Trading stocks and all other financial instruments involves risk. You should not make any investment decision based solely on what you hear. Stansberry Investor Hour is produced by Stansberry Research and is copyrighted by the Stansberry Radio Network.